there is no riskless asset. Even if you had it all in green and it was in, in your house under your mattress, like what if somebody steals it? What if your house catches fire? I mean, you got inflation. I mean, there is no true riskless. But if you're talking cash being, the barometer for risk, this is just a very, very, very small step above cash. Chris, you want to talk just a little bit about the difference between money market and bank deposit? Just something that, again, this is probably an evergreen topic that people can refer back to. We constantly talk about buying money market, and the first question is it safe? Is it safe? Well, how is it different?
Yeah, and so some of these rules have changed over the last even 15 years. And after 2008, some of those rules changed, but the general bank sweep, whether it's in a at your bank or in a brokerage account, the general bank sweep typically goes into some FDIC insured account that's at some bank that's behind. So in many cases, there's a bank that's owned by the brokerage company, and that's where they sweep the cash balances to. And they pay, right now, they pay a pretty low rate relative to what we would otherwise call money markets. But there is a difference. One of them is FDIC insured and has very strict rules around how you can collect on that if a bank were to ever fail, whether it's if your small community bank is FDIC insured, then it's got the exact same rules and some of the same limits. But money markets are a little bit different. They have rules around what they can invest in. They typically have to be shorter than 1 year instruments that are inside there. But their whole goal as a manager of a money market fund is to provide the best yield for owners of that mutual fund. And so your average in there is often somewhere around average maturity of the bonds that are in there, somewhere typically around 3 months, maybe a little bit shorter. And it provides daily liquidity. In other words, we would have to go in for a client and sell that particular position if we wanted to raise cash out of it, unlike the sweep accounts where you can just write a check against it. So, but it's worth some of the lifting for us to do for clients if we can lock money up and we need, and clients can give us 2 or 3 days notice to be able to access that. It's also where we keep strategic cash sometimes for clients. So in investment portfolios, we typically don't want a ton of cash sitting in the sweep account that's giving us
40
less than 0.5%. When we can get on strategic cash, we can get north right now of 3.5%. So it's not always that way, and sometimes we differ, but certainly right now it's a great place for people that do have cash to be able to park it in a really conservative way and get paid to do that.
Yeah, a couple other points on the money market. So dollar for dollar, so stays at $1 per share. So unlike basically all of your other investments, which have a fluctuating principal value, you put $50,000 into a money market, you get 50,000 shares at $1 per share. So it is more stable. Like clients view cash, but it is still an investment. The other thing about money market is because it's very short-term instruments that they're investing in, the yield will fluctuate based on rates. So they'll always give you an annualized yield that if you held this and nothing changed for 12 months and you reinvested all the dividends, I think today it's at like 3.77%. They call it a 7-day effective yield on one of these money market instruments. But let's say the Fed comes out in a month or two and cuts rates. Well, then right away, the investments in that portfolio are going to yield less. And so the rate on the money market is going to go down. Now, if the Fed raises rates, you'll see yields continue to increase. But it's not a locked in rate like you would get from a CD. It is a constantly evolving rate. But again, this is part of investing and knowing where the market goes. And we just talked about, we expect rates to not only remain, but probably increase from here at least for half a next year, maybe even longer. So there's a good chance that it's not just this rate, but maybe it's even a little bit higher for money market. So for us, again, every situation is different, and that's why we talk to individual clients about their situation. But 40 basis points for sweep versus over 3.5 for money market, that's a pretty compelling risk decision.
Well, you talk about trade-offs all the time. The big difference between the money market and the bank sweep is the guarantee and the backing of the FDIC. So it's there's no free lunch, but this is pretty close. You're not taking on a tremendous amount of risk by moving out of the bank sweep and going to a money market that's giving you in some cases 10 or 12 or 15 times as much return for just a tiny bit more risk.
And like I mean, I know these are kind of facetious examples, but there is no riskless asset. Even if you had it all in green and it was in in your house under your mattress, like what if somebody steals it? What if your house catches fire? I mean, you got inflation. I mean, there is no true riskless. But if you're talking cash being the barometer for risk, this is just a very, very, very small step above cash and way far away from being into your typical, bond, stock, type investment.